Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Phoenix Education Partners, Inc. quarterly report. Phoenix Education Partners, Inc., through its subsidiary, the University of Phoenix, Inc., offers various businesses and services to cater to the needs of working adults and employers alike. One of the primary services provided by the company is online higher education for working adults in the United States. This service allows individuals to pursue their academic goals while balancing work and other responsibilities. In addition to its educational offerings, Phoenix Education Partners, Inc. also provides talent solutions programs for employers. These programs include a talent sourcing platform that connects employers with students whose skills profiles align with job postings. The company's AI-powered tool is another key feature of its talent solutions program, which scans an employer's inventory of sought-after skills and designs development pathways to internal job opportunities. Overall, Phoenix Education Partners, Inc.'s services are designed to support both individuals seeking higher education and employers looking to develop their workforce. Phoenix Education Partners, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $33 billion. Phoenix Education Partners, Inc. trades at a lower price-to-earnings ratio of 11 times and a higher price-to-book ratio of 3.95 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The leverage on the balance sheet appears elevated, with liabilities of 51% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through a review of recent financial data. On the positive side, revenue from education services has seen a significant increase of 9% in 2026 compared to the previous year. This growth is also reflected in enrollment numbers, which have risen by an average of 2.9% over the past 6 months. Additionally, career-relevant education and employer relationships have contributed to a notable increase in enrollment through this channel. However, there are also areas where revenue has declined. Corporate training revenue has dropped to zero in 2026 from $1 million in 2025, representing a 100% decline. Furthermore, the company is facing challenges related to discharged federal student loans due to BDR claims and potential recoupment efforts by the Department of Education. The net revenue picture is mixed, with a decrease of $37,275 from 2025 to 2026, but also an increase of $6,390, or 1.3%, in the 6 months ended February 28, 2026 compared to the prior year period. Overall, these trends suggest that while there are areas where revenue is growing, others are experiencing decline, and the company's financial performance remains a subject of concern. The financial performance of a company has undergone significant changes in the past year. A notable decline in net income was observed, with a decrease of 33.1% for the 3 months ended February 28, 2026, and a staggering 58.1% drop for the 6 months ended on the same date. This downturn is attributed to increased interest expenses and higher effective tax rates. The profit margins have also taken a hit, plummeting from 7.2% in 2025 to 4.8% in 2026 for the 3-month period, and from 13.1% to 5.4% for the 6-month period. Several factors contributed to this decline. Firstly, the company experienced a decrease in accounts receivable, accompanied by an increase in provision for credit losses on these receivables. Additionally, impairment charges and asset disposal costs weighed heavily on the financials. The discharged federal student loans and potential recoupment efforts also had a negative impact on the company's net income. These factors collectively resulted in a significant decline in profit margins, indicating a challenging period for the company's financial performance. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the latest figures, the company has achieved positive operating cash flow, which is a significant indicator of its financial health. A closer look at the numbers reveals that for the 6 months ended February 28, 2026, the net cash provided by operating activities was $79,954. This substantial amount of cash generated from operations demonstrates the company's efficiency in managing its resources and converting profits into cash. This positive trend is a testament to the company's effective management practices and its ability to sustain profitability over time. The generation of positive operating cash flow also provides the company with the necessary funds to invest in growth initiatives, pay off debts, and reward shareholders, ultimately contributing to its long-term success. The company's debt level and interest expenses have shown some fluctuations, but not necessarily significant changes. The total liabilities decreased by $677, indicating a slight reduction. However, this decrease was offset by an increase in other long-term liabilities from $27,110 to $36,298. In terms of interest expenses, the 3-month period ended 2026 saw a substantial decrease from $111,000 to $550,000. Conversely, the 6-month period showed an increase from $225,000 to $765,000. Despite these variations, net interest expenses were calculated to be -$2.35 million for the 3 months and -$4.32 million for the 6 months, indicating a significant expense burden. Overall, while there have been some changes in debt levels and interest expenses, they do not appear to be substantial or indicative of any major shifts in the company's financial situation. Management is optimistic about the company's future outlook, citing opportunities for sustainable growth driven by customer enrollment expansion. They plan to offset declining student numbers through increased new student enrollment and investments in areas that improve retention and graduation rates. The company will also focus on strengthening employer relationships, which currently account for 34% of enrollment, to drive further growth. To achieve this vision, management is investing in optimization initiatives to reduce friction points and increase efficiencies. They aim to augment historical operating leverage through additional strategic and operational efforts. The company's strategy encompasses maintaining institutional accreditation, participating in Title IV programs, adapting to changing market needs, and attracting top talent. By executing these plans, the company expects to continue experiencing growth despite current trends of lower net revenue during holiday breaks. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company has paid regular quarterly cash dividends, with a payout of $0.21 per share in Q2 2026 and approval for Q3 2026. This indicates a consistent approach to rewarding investors. In addition to dividend payments, the company has also implemented a share buyback program, adopting a plan to repurchase up to $50 million worth of shares on April 3, 2026. This move suggests that management is confident in the company's financial position and is willing to invest in its own stock to boost shareholder value. Overall, these actions demonstrate a clear focus on returning value to shareholders through both dividend payments and share buybacks, indicating a commitment to creating long-term value for investors. That concludes the financial summary for Phoenix Education Partners, Inc. Feel free to comment below, and I will be happy to answer them when possible.